The landlord is responsible for contracting for all repairs and services and will probably get a better deal because they're able to purchase in volume. There's also the time of trying to sell. What if it takes 6 weeks? What if it takes 6 months? What is the time necessary to have the house ready to show, to vacate the house during showings, to keep it on the market as a viable candidate for all of the homes in your particular area? And what is the opportunity cost of this immobility, of the time and expense that it takes to move? Career opportunities, professional opportunities, business opportunities that might not be available because you are anchored to a particular home in a particular geographic area. This is Mark Shupe, the author of the Moneyball Method, a middle-class manifesto for objective investing. Last week, I published a book review titled Bringing Adam Smith into the American Home. It was written by John Tamney, and it talks about home ownership in terms of whether or not it is a good deal for most Americans. And this is important, especially in light of the so-called affordability crisis, one that is mostly set on housing and the housing shortage and rising mortgage rates and rental rates. And this book review and this book have had a mixed reaction. It's difficult for many people to understand that perhaps home ownership isn't as good an investment deal as they had thought. And that is what I'd like to discuss today, is owning your own home in terms of an investment. And I'd like to start with something known as the Castle Doctrine. The Castle Doctrine is a legal situation that currently happens with regard to the right to defend yourself and your home and your property in the case of home invasion. But it actually goes back about 400 years to the time of early 17th century England, in particular Sir Edmund Coke, who coined the phrase, "a man's house is his castle." And clearly, your home, your house is your place for security, for privacy, and if you own your home, it is a source of pride and something you can customize and perhaps leave as a legacy to your family for future generations, a place that children and grandchildren remember growing up. But I'm here to talk about owning a home in 21st century America during the information age, post-industrial revolution, and do that in terms of economics and finance. And in my book, The Moneyball Method, Chapter 5, I listed 10 risks that are associated with every business, every stock that you might own. There are business risks involved. They are known as idiosyncratic risks. I discussed them a couple of weeks ago, but I want to talk about them in terms of home ownership. One of the risks of owning your own home is economic risk. What happens if the economy goes into recession? What happens to the value of your home in that event? What happens to your income stream in that event? Your ability to make your mortgage payments? What if the recession causes you to lose your job, to go into default on the mortgage, to have the house foreclosed and lose your equity? That doesn't happen very often, but it is a risk and it is associated with economics. Then there is political risk, particularly with regard to municipalities, local jurisdictions. Property tax rates are subject to the whims of the local government. If tax rates go up, that might increase your mortgage payment if you escrow the taxes. Certainly have a negative impact on cash flow, whether you escrow your taxes or not. And there are also zoning ordinances. How will those impact the market value of your home? How will they affect demand for your home if and when you want to try to sell it? A third risk is interest rate risk. Interest rate risk is particularly effective with regard to adjustable rate mortgages. If you do not have a fixed rate mortgage, if you have not locked in your payment, your mortgage payment might be subject to a reset. And that reset could be every 12 months. It could be every 3 years or 5 years. It depends on the terms of the mortgage. And usually there is a maximum amount that it could reset at any given point in time. However, we've seen interest rates rise sharply over the last 3 years. We've seen mortgage rates rise sharply. And if you had an adjustable rate mortgage, you had your mortgage payment rise sharply. But interest rate risk also affects supply and demand for mortgages and for homes. Owning a home, if you're going to finance that home with a mortgage, might become less affordable, or you may have to purchase a smaller, less expensive home. So mortgage rates, interest rates will have an impact on who's willing to buy your home if and when you decide you need to sell. The fourth risk is financial risk, your particular financial situation. If you have cash flow problems, that could be a risk regarding the equity in your home if you needed to sell or if you were foreclosed. Equity losses are a big deal because a person's equity in their home, if they own the home a long time, could be a substantial portion of their net worth, maybe in some cases their entire net worth, or their entire net worth not including their tax-qualified retirement plan. The fifth risk is inflation risk. Now, inflation risk is particularly onerous when it comes to intangible assets like stocks and bonds, securities backed by paper. A home actually is an inflation hedge. So with regard to inflation risk, owning a home is a good thing. Owning any existing asset, hard asset, would be a good thing in a time of rising monetary or price inflation. The same applies to unimproved land, precious metals like gold. Any existing asset or hard asset, as they call it, would be an inflation risk hedge. However, at the same time, it is a penalty to savers. The equity that you're building up in your home may be growing in dollar terms, but it is shrinking. It is shrinking by the rate of inflation. Remember from several previous podcasts, money serves the purpose of being able to convert it into something that is useful to you. Material goods and services are what give money value. By itself, money really has no value. So inflation is an insidious tax that eats away at the equity in your home or the value of any assets that you might own, whether they be tangible or intangible. The sixth risk, and this is a big one, and it was a major theme in the book Bringing Adam Smith into the American Home, and that is liquidity risk. Liquidity risk is what does it cost to be able to sell something, and how long will it take, and will you have to sell at a discounted price if you need to sell quickly? The time, the trouble, the anxiety, the expense associated with selling a home is substantial. And one of the reasons that it is so substantial is because of a cartel known as the National Association of Realtors. Because of the internet, because of technology, because of innovation, we've seen the price of transactions for almost every commodity and service decline sharply over the last 20 or 30 years. We've seen the volume of transactions increase sharply over the last 20 or 30 years. Let me give you an example. The crash of 1987. Black Monday. I was there. I was working in a brokerage office in central Kentucky on Black Monday, October 1987. The trading volume overwhelmed the New York Stock Exchange. It was 600 million shares. Today, that's about 10 minutes worth of trading. The price of trading securities has dropped sharply. The volume of transactions has increased sharply. The brokerage industry is none worse for the wear. And the same would be true for the real estate industry if they were to get with the times. The cost of trying to sell a home is onerous. Right now, the going rate is about 6% to list your home and have it on the multiple listing services network, which is controlled by the National Association of Realtors. Then there's also the subject of taxes. One reason that you would not want to sell a home is because of capital gains taxes. You can defer those taxes if you were to reinvest in a similar property, and then you could pass that along to heirs through your estate through a living trust with stepped up basis, perhaps. However, there are tax ramifications associated with selling your home unless you were able to defer. Then there is the subject of appreciation. That's where the investment piece comes in. Most of the people that saw my book review were challenged me to explain how their home could not be such a great investment. They've owned it a long time. It may have increased in value by 5 times, maybe tenfold. That's a great investment. Plus the tax deductibility of the mortgage interest that they may have paid. When I say with regard to the appreciation, the return on a home, I say compared to what? Over the last 25 years, the S&P 500, the U.S. stock market, has outperformed the average residential real estate price appreciation. In the meantime, you had complete liquidity during that period of time. In the meantime, you did not have the cost of homeowners insurance, property taxes, maintenance. It could be roof, it could be foundation, it could be replacing a hot water tank, it could be repainting, recarpeting, replacing an air conditioning unit or a furnace, plumbing problems, electrical problems. All of these are not only expensive to owning a home, they cause anxiety and they are time consuming. But some people are skilled at that. Most people are not. Some people like home maintenance chores. They like to upgrade their property. They take pride in that. That is respectable. That's important. However, it is a cost of ownership. And if we're looking at this in terms of its investment potential, it is something that is important. Also, owning a home is not a capital asset that does anything to help the economy in general. It is an existing asset. It doesn't do anything other than provide you with something extremely important: shelter, security, comfort, privacy. These are very important, but they don't do much for anybody else, as opposed to future assets, investments in intangible securities such as equities, the stock market, venture capital, whatever the case may be, owning your own business. So not only is owning your home a consumption asset, it is not a capital asset. Let's talk about the appreciation. What caused your house to appreciate in dollar terms? The key is in dollar terms. Relative to the price of gold, did your house appreciate at all, if anything? Over the last 25 years, I think it's fair to say that the value of the dollar compared to the price of gold has lost about 90% of its value. Lo and behold, the value of your home may have gone up 5 to 10 times. Nearly 100% of the price appreciation in dollar terms of your home is because of devaluation of currency. Again, it's a hard asset. It's an existing asset. It has no internal rate of return. And that's where I would like to define an investment versus other assets. If it has an internal rate of return, it is an asset. It is an asset based on future wealth expectations. It is an asset that is based on the productivity of free people engaged in voluntary transactions in free markets with people across town, across state lines, and all over the world. So with that, I'd like to wrap up my comments about your home as an investment in terms of time and in terms of mobility. In terms of time, Is owning your home worth the time that you spend on dealing with things that you are not skilled with? Electrical repairs, plumbing repairs, roof repairs, foundation repairs. These you need to hire. You may get a good deal from a local contract to make the repairs efficiently, or you may have to pay a premium price to get it done quickly so as not to disrupt your comfort and privacy. If you were to live in a housing complex or perhaps rent an individual home, the landlord is responsible for contracting for all repairs and services and will probably get a better deal because they're able to purchase in volume. There's also the time of trying to sell. What if it takes 6 weeks? What if it takes 6 months? What is the time necessary to have the house ready to show, to vacate the house during showings, to keep it on the market as a viable candidate for all of the homes in your particular area? And what is the opportunity cost of this immobility, of the time and expense that it takes to move? Career opportunities, professional opportunities, business opportunities that might not be available because you are anchored to a particular home in a particular geographic area. So time and mobility are probably the two greatest concerns with regard to home ownership as an investment. After all, whether we're investing in stocks, in savings accounts, in bonds, or in real estate, we are hoping to raise capital for future consumption, to enjoy the things that we enjoy doing the most, that make your life worth living, that give it meaning and purpose. We are buying time. So with regard to time as the ultimate payoff for any investment choice, that is the perspective I'd like to leave you with today. Thank you for joining me. I hope you have a wonderful Christmas and Happy New Year, and we will talk again next week. Happy New Year.